Good evening. Breaking tonight, a Russian oil tanker seized by U.S. authorities has triggered what analysts are calling an unprecedented financial countermove that could shake the foundations of the global silver market. What appeared to be routine sanctions enforcement may have inadvertently accelerated the very outcome Western policymakers have been trying to prevent: the construction of alternative financial systems that operate entirely outside dollar hegemony. The seizure of the Russian-flagged vessel carrying Venezuelan crude oil occurred 3 days ago under existing U.S. sanctions authority. The vessel, which had been tracked by maritime intelligence services for several weeks, was intercepted in international waters and escorted to a U.S. port. Officials characterized the action as standard enforcement of sanctions prohibiting the transport of Venezuelan crude by Russian-affiliated entities. But sources close to the situation, speaking on condition of anonymity, say this action has done far more than remove one ship from circulation. It has accelerated a bold and potentially market-shattering plan already in advanced development between Moscow, Caracas, and Beijing. According to these intelligence reports, Russia and Venezuela are now finalizing arrangements for a direct oil-for-silver trade corridor that fundamentally bypasses every lever of financial control the West has traditionally relied upon. This isn't speculation or theoretical modeling. This is a fundamental restructuring of how sanctioned nations plan to conduct energy commerce going forward, bypassing the US dollar, bypassing the SWIFT international banking system, bypassing Western financial institutions, and most critically, bypassing traditional commodity exchanges entirely. The implications of this shift, if it comes to fruition, extend far beyond energy markets and could represent the most significant challenge to Western financial architecture since the collapse of the Bretton Woods system in 1971. Let me break down what we know. Venezuela currently produces approximately 800,000 barrels of oil per day. Production has declined significantly from historical peaks above 3 million barrels per day, but the nation still sits atop the world's largest proven oil reserves. Russia, despite being a major oil producer itself, faces mounting export restrictions and is actively seeking stable sources of heavy crude that complement its own production profile. Venezuela's heavy crude is exactly what Russian refineries need for specific product blends. According to the framework being discussed, Russia will become a primary buyer of Venezuelan crude, with bilateral trade potentially handling 200,000 barrels daily in the initial phase. At current market prices of approximately $80 per barrel, we're looking at $16 million in transactions every single day. Scale that up, $112 million per week, nearly $500 million per month. Over a full year, that's close to $6 billion in bilateral trade volume. Here's where the story takes a dramatic turn. Under the new arrangement being finalized, these transactions will not be settled in US dollars. They will not flow through correspondent banks in New York or London. They will not touch the SWIFT messaging system. Instead, every barrel of oil will be paid for in physical silver bullion, with China's state-owned enterprises acting as brokers and logistics coordinators. This is not a barter arrangement in the traditional sense. This is the construction of a parallel commodity-based settlement system using silver as the intermediary asset. Russia will purchase physical silver, likely through Chinese intermediaries, and deliver it to Venezuelan accounts. Venezuela will use that silver to purchase goods from China or other trade partners, or potentially convert portions back to hard currency through non-Western exchanges. The circle remains closed to Western oversight, and this is where the story becomes critical for global financial markets. To settle these massive oil purchases, Russia and its partners will need substantial quantities of physical silver. Not paper contracts, not futures positions, not ETF shares, but actual metal bars delivered from vaults and transported to designated locations. The primary sources for this quantity of silver are the COMEX in New York and the London bullion market. These institutions have operated for decades on what industry insiders refer to as a fractional reserve model. For every physical ounce of silver actually sitting in their vaults, there exist multiple paper claims on that silver: futures contracts held by speculators, shares in exchange-traded funds, unallocated accounts that represent claims rather than segregated metal, and various derivative instruments. Conservative estimates suggest a ratio of 100 paper ounces for every physical ounce. More aggressive estimates put that ratio between 250 and 500 to 1. The exact number is impossible to verify because the system operates with limited transparency, but the fundamental structure is not in dispute. There are far more claims on silver than there are actual bars available to deliver. The system has functioned smoothly for decades because it's built on a critical assumption that most participants will never demand physical delivery. Speculators close out futures contracts for cash. ETF shareholders trade shares without ever requesting the underlying metal. Industrial users maintain relationships with specific refiners. The equilibrium holds because delivery requests remain predictable and manageable. But Russia, Venezuela, and China, operating as sovereign nations with strategic geopolitical objectives, are not traditional market participants. They don't close out contracts for cash settlements. They don't trade paper shares. They demand delivery of physical metal, and they have the infrastructure to store, secure, and transport it. Current COMEX data, which is publicly reported, shows approximately 300 million ounces of silver in registered inventory. That's the category of silver theoretically available for delivery against futures contracts. That sounds like a substantial buffer. But let's examine what happens when we account for realistic constraints. First, remove silver held by central banks and sovereign entities who are not sellers at current prices. That's roughly 40 million ounces. Next, remove silver already committed to existing ETF structures that cannot legally be diverted without triggering redemption crises. That's another 80 million ounces. Then account for minimum inventory levels that major dealers must maintain to satisfy industrial clients with ongoing contracts. Another 60 million ounces. Finally, recognize that not all registered silver is immediately available. Some is in transit, some is encumbered by legal claims, some is held by entities that simply won't sell at prevailing prices. When you work through these adjustments, available supply for large-scale new delivery demands drops to a range of 50 to 80 million ounces. That's the realistic buffer against a sustained delivery campaign by sovereign buyers. Now let's do the math on Russia's potential silver requirements. At $30 per ounce, approximately the current silver price, Russia would need roughly 533,000 ounces of silver to settle 1 day's worth of oil purchases at $16 million. That's 16 million ounces per month, or 192 million ounces per year. If Venezuela negotiates similar arrangements with other buyers, or if other sanctioned nations adopt this model, you could easily see monthly demand of 20 to 30 million ounces in physical delivery requests. At 25 million ounces per month in sustained delivery demands, the available COMEX registered inventory of 50 to 80 million ounces gets depleted in approximately 60 to 90 days. Let me emphasize this point. We're not talking about a temporary squeeze that resolves in weeks. We're talking about structural demand that doesn't stop because it's based on ongoing energy commerce, not speculation. What happens when the COMEX can't deliver? When standing for delivery means waiting months for metal that should arrive in days. Market analysts warn of several potential scenarios, all of them disruptive. First scenario, force majeure declarations. The exchange claims an extraordinary event beyond its control and suspends the delivery obligation, offering cash settlement instead. This has precedent in other commodity markets during extreme dislocations. Second scenario, emergency rule changes. The exchange alters contract specifications, changes delivery timelines, or implements position limits that prevent any single entity from demanding excessive quantities. This is essentially what happened during the Hunt Brothers silver crisis in 1980. Third scenario, de facto two-tier pricing emerges. Paper silver continues trading on the exchange at one price, while physical metal commands massive premiums in the cash market, effectively creating separate markets for claims versus metal. Any of these outcomes represents a systemic failure of the paper silver market and, more importantly, a crisis of confidence in the entire commodity derivatives complex. If silver futures can't deliver metal, why should anyone trust gold futures, copper futures, platinum futures? The contagion could spread across the entire commodity sector. We have historical precedent for market corners and delivery squeezes. In 1980, the Hunt brothers of Texas, using billions of dollars in borrowed money, attempted to corner the silver market by taking massive long positions and demanding delivery. At the peak, they controlled nearly half the world's deliverable silver supply, and prices spiked from $6 per ounce to over $50. The situation was resolved through a combination of exchange rule changes that made it harder to maintain large positions, regulatory intervention, and ultimately financial pressure that forced the Hunt brothers to liquidate. But that was a speculative play by private investors seeking profit. They could be pressured, regulated, and ultimately stopped. This situation is fundamentally different in several critical respects. These aren't speculators trying to manipulate prices for trading gains. These are sovereign nations building alternative trade infrastructure with long-term strategic imperatives. Russia cannot be margin called. Venezuela's central bank cannot be forced into liquidation by its prime broker. China's state-owned enterprises don't face redemption pressure from nervous fund investors. Moreover, these nations aren't trying to corner silver to drive prices higher and flip positions for profit. They're using silver as a settlement mechanism for ongoing commerce. They need the metal to function as a medium of exchange in a dollar-free trading zone. The objective isn't market manipulation, it's market independence. If they succeed, if they demonstrate that large-scale commodity trade can occur entirely outside Western financial infrastructure, the implications extend far beyond silver. They will have proven that the dollar's role as the global reserve currency and the primary pricing mechanism for commodities is not inevitable. It's optional. And if it's optional, other nations will exercise that option. The dollar's dominance in global trade isn't backed by force or law, it's backed by network effects and convenience. It's easier to use dollars because everyone else uses dollars. But if a viable alternative emerges, those network effects can unravel rapidly. The dollar doesn't need to be displaced overnight. It just needs to be displaced at the margins, in growing volumes, until a tipping point is reached. Consider the potential timeline for how this unfolds. In week 1, negotiations that have been ongoing for months reach final agreement. Legal structures are established in friendly jurisdictions. Chinese state banks set up the necessary accounts and logistics. Early test transactions move small quantities of oil and silver to verify the system's work. In month 1, the first major oil shipments move through the new trade lane. Russia requests initial silver deliveries from London and COMEX vaults. Modest quantities, perhaps 3 to 5 million ounces. These requests are filled without difficulty. Markets barely notice the incremental demand. Silver prices remain stable. In month 2, delivery requests accelerate to 15 to 20 million ounces as the oil trade volumes increase and other parties begin participating. Silver premiums in the physical market start rising as dealers notice that large quantities are leaving vaults and not returning. Mainstream financial media runs a few stories about tight silver supply. Analysts attribute it to industrial demand or investment flows and call it temporary. In month 3, the crisis becomes undeniable. COMEX registered inventory falls below 30 million ounces. Delivery delays begin occurring. Large contract holders who are planning to stand for delivery are quietly approached by exchange officials and encouraged to accept cash settlement instead. Some do, others refuse and insist on metal. Silver prices spike to $40 per ounce, then $50 as market participants realize that physical delivery is no longer certain. By day 90, the breaking point arrives. Force majeure declarations are issued. Trading in the most stressed contracts is temporarily halted. Congressional committees schedule emergency hearings. Regulators launch investigations. Media coverage intensifies. But the damage is already done. The paper silver market has been exposed as a fractional reserve system that cannot honor its commitments under stress. And Russia? Russia is sitting on accumulated physical silver reserves and has a functioning oil for silver trade network that operates entirely independent of Western financial infrastructure. No sanction can touch it because there are no dollar transactions to block, no SWIFT messages to intercept, no correspondent bank accounts to freeze. Market projections for silver prices in this scenario vary dramatically depending on assumptions. Conservative estimates, assuming some degree of increased mining production and recycling supply response, place silver at $100 to $150 per ounce. More aggressive projections, assuming a broader crisis of confidence in paper commodity markets and a rush into physical precious metals as stores of value, reach $250 to $500 per ounce. Some outlier forecasts suggest even higher peaks if the dollar's commodity pricing role faces fundamental challenge. But price is only one dimension of this story. The more profound impact is structural. If sovereign nations can conduct billions of dollars in commerce using physical commodities as settlement mechanisms entirely outside the dollar system, then the foundational assumption of American financial power, that all roads lead through New York, becomes obsolete. The United States has wielded sanctions as a foreign policy tool with increasing frequency over the past 2 decades. The implicit threat is always the same. If you don't comply, we'll cut you off from the dollar system, from SWIFT, from correspondent banking, from the global financial infrastructure. That threat works only so long as there is no viable alternative. Russia, China, and their partners are now building that alternative, using commodities as the foundation. Silver is almost certainly just the beginning. If this model succeeds, expect to see gold for gas arrangements, copper for coal swaps, rare earth for agriculture trades. A whole parallel commodity-based trading system could emerge with China as the central broker, physical assets as settlement mechanisms, and the dollar nowhere in the equation. The geopolitical implications are staggering. American military power remains unmatched. But military power cannot force nations to use the dollar. It cannot prevent bilateral commodity trades conducted in neutral jurisdictions. It cannot stop the slow erosion of dollar dominance if credible alternatives exist. From a market perspective, investors face a stark choice. If this scenario unfolds as described, physical precious metals become not just inflation hedges or portfolio diversifiers, but strategic assets in a restructuring global financial system. The challenge is that by the time the mainstream financial media confirms the story, by the time the COMEX delivery failures make headlines, the opportunity to position at reasonable prices will have passed. Physical silver premiums will be prohibitively high if metal is available at all. The broader lesson is that financial warfare is a double-edged sword. Every sanction creates an incentive to build alternative systems. Every asset seizure accelerates the search for seizure-proof alternatives. Every restriction on dollar-based transactions makes non-dollar systems more attractive. The United States has been wielding these tools with increasing frequency, apparently confident that there are no alternatives. That confidence may be misplaced. What began as a routine sanctions enforcement action against a single Russian oil tanker carrying Venezuelan crude may have triggered precisely the response it was designed to prevent. By demonstrating that even legal maritime commerce can be unilaterally disrupted, the United States has made the case for alternative systems more compelling than any Russian or Chinese propaganda ever could. The next 90 days will be critical. If Russia, Venezuela, and China execute this plan, if they successfully drain physical silver from Western vaults to settle energy trades, if they prove that large-scale commerce can operate independent of dollar infrastructure, then the post-World War II financial order faces its most serious challenge in decades. They seized a tanker. In response, they may lose control of the silver market, and potentially much more. This isn't just about one commodity, it's about the architecture of global finance. And right now, that architecture is being stress-tested in ways its designers never anticipated. Checkmate. That's the situation as we understand it tonight. We'll continue monitoring developments closely. This is very much a developing story, and the implications are only beginning to come into focus. Stay informed.